Today, we have one of the rare few who blend art and deals together, an experienced architect with over 30 plus years of experience, also a multifamily developer and operator. You are getting to tap into the wisdom today of my guest, Mr. Mark Schuler of Schuler Architecture and SGRE Investments. They have a portfolio that spans 4,000 plus multifamily units and many different projects across two different states, one in a very blue state of Washington and a very red state of Texas. And you're going to hear how an investor of this magnitude has navigated the politics, the challenges that happen in these two different states, as well as some of the opportunities and the advantages and the overall perspective that he has on investing in red versus blue, in addition to all of the great lessons that he's learned with underwriting, how he feels about operations and streamlining and optimizing their assets through sound management. We talk about the multifamily market and the state of the industry as a whole. Mark is somebody who's extremely data driven. And so he released a white paper, I think had over 65 cited articles and data points that really give some great insight that we actually pull up in today's episode and talk a little bit about that. He even mentions his concerns over a black swan event and how they are thinking about it, protecting against it, and what you should do as an investor, whether you're active or passive in real estate deals, to really build a moat around your overall wealth and investment strategy going forward. I think you're going to enjoy today's conversation. Very tactical, very data driven, and very value packed. So without further ado, let's dive into today's episode. Well, I'm excited to dive in with Mr. Mark Schuler. How we doing, brother?
I'm good, thanks.
So you've been a licensed architect for 38 plus years? Is that correct?
Yeah, since I think I got my license in 1992. So, however, I'm dating myself, but yeah, yeah, started, studying before that. Was always kind of on that track. Even in high school, I was going to be an architect. So, a long time.
And you've built or been a part of building 500 plus projects.
Yeah.
And what was it that kind of took you from, being in the kind of consultant seat and a vendor for investors and developers to going, I think I want to get on the other side as well and kind of get into the ownership, the GP side?
Well, as an architect, I had a lot of investor and developer clients, and kind of interfacing with them and looking over their shoulder taught me a lot. But saw them making all this money, and it's like, they're definitely not as smart as I am, and I can certainly do what they do. So, back in the early aughts, I went back to school and got a degree from University of Washington Business School, commercial real estate development. And, but before that, I was just always been fascinated with the industry. It is a fast-moving, dynamic, complicated, challenging industry, which has always just fascinated me. You're playing with the built environment, and so a little bit, I guess you get to play God. But as an architect, I was always and studied, how my buildings impact the built environment in people's lives. So I just got to do it on a larger scale. So
I love that because, I think for a lot of people, until I got into investing in commercial real estate, until I got into the development, it's kind of like you don't know enough about it to care. And then once you get in and you start understanding everything that goes into investing, everything that goes into development, everything that goes into planning, everything that goes into the community, there's so, like you said, so many, nuanced variables in this challenging situation or I guess industry. How did your early work in design kind of prepare you for commercial real estate? And what value do you feel like that skill set kind of brought and carried over into the side that you're playing on now?
It certainly gave me an insight into how much government can impact development. make or break a project.
Yeah, they can.
And it just, if you don't understand the permitting process or the regulatory process for real estate and development, buildings in general, this is a really difficult business to do. And what I always tell people, if you don't have those skill sets, you need to partner with somebody. And if you can't partner with somebody, you need to hire somebody. So my having a real intimate understanding of how the game works is really helpful. And, then going out, doing a 250 unit syndication, for instance. I mean, I just understand the impact that government can have on my projects.
Yeah.
We do heavy lifts on a lot of our projects. So we're hiring a lot of licensed trades, you know, buying a lot of projects and dealing, a lot of TLCs. So, just understanding where government's going to interface in my process, and then can immediately, filter that down to ROI on about half of my investors, for instance.
Yep.
So, putting together project timelines and understanding how rapidly we can turn these units, do all this exterior work. So that's a real big advantage I have over a lot of folks.
Yep.
And it's ever evolving. Codes get updated every 3 years. In the state of Washington, we had this thing called the Washington State Energy Code. It is the most robust in the country. And it is really making development challenging. Trying to navigate through that. I mean, after this podcast, I have a phone call with my energy code consultant as we try to grind through kind of what the regulatory implications are on a simple little dado that I'm doing. But it's like they have made this code so complicated, convoluted that it's a challenge, to say the least.
And I agree with you. I mean, I've developed in states that you can go in on I live in California, so
Oh, you're not doing that there.
so you and I are, on we'll call it the Pacific Northwest, and I would say we're of the most challenging states to develop in, the hardest to navigate, the most cumbersome, the most time intensive, the most money intensive. And oftentimes, right, you're not getting people that are, even though you're doing great things for the community, they're not lining up to go, yay, development, good job, right? And then there are other states and cities and municipalities that are like that do want to push these things through. So I'm curious from your perspective on why you guys have chosen to stay developing in challenging states and climates that maybe aren't as development friendly, and what you guys have done about that with your business model, knowing that, SGRE investments, you guys, I think, hold around 2,000 multifamily units.
And it's more like 4,000.
Okay. Well, there you go. We need to update your bio then, because you're selling yourself short there. And obviously, you guys have really navigated two kind of different markets, right? Houston and Texas being one, and then Washington. You got red and you got blue. We can keep politics out of it, but at the same time, policy does matter and impact real estate investments, your overall asset, your business model. So I'm just curious how you've kind of navigated and thought about that, coming from one very blue and going to one that's red, and playing in both successfully. What does that look like for you as a developer, and what have other, developers kind of taught you in that process?
Well, I purposely went to Houston.
Okay.
Because I got tired of the development game up here in Seattle and Western Washington. I have tapered off this market because it is, you can't make the numbers don't, unless you are an institutional player.
Right.
And, there are still plenty of buildings going up in downtown Seattle and the outlying areas, but at this point, it's a Wall Street. I can't, I don't have enough of an operation built up. I mean, we were talking before we got on this podcast about a couple of brothers who've been doing it for 30 years here. I mean, they're sort of mid-level guys, and they've been doing it very successfully. But I assure you that their projects are very strategic, and they're playing in specific jurisdictions. I would venture that are a little more friendly than other jurisdictions in the area. I can't play that game here anymore. And so I made a strategic decision to go from the bluest of the blue to the reddest of the.
Mhm.
Houston is very hands off. There's no zoning in Houston. And so I go from a very tightly controlled market to, like a no holds bar. I mean, you will find a $2 million mansion next to a 7-Eleven and a strip down in Houston. I mean, it's hard to reconcile going back and forth between the two. But what I like most about Houston is that the landlord tenant laws are they are a lot saner than they are certainly in Seattle, which is very anti-landlord. Uh,
Right.
and I mean, I can't evict people 9 months of the year. And the state of Washington just 3 weeks ago passed statewide rent control. So it's just like, I was looking for the exit about 8 years ago because I could see it coming.
Yeah.
And and I know a lot of people who still do it here are kind of smaller players, and they just can't get any returns on their projects. And this is including, opportunity zone credits, all that. I mean, it's just hard to develop.
Yeah.
Because it is so expensive. So I didn't want to go through all those migraines and come up short on the short stick every time. So gone down there and then focused on the value add game. And yeah, it's a lot saner down there. If you don't, in exchange for the privilege of living in one of my units, you get to pay your rent. What a concept!
Who would have thought?
That is not the rules here in Seattle.
Yeah.
That is not the rules. I've had squatters sit in my buildings for 4 years and not pay their rents, and I could not get them out. And so, how do you do business in an environment like that? Much less pay your investor.
Yeah. Yeah. I mean, right. Especially when you're raising capital and you're promising yield and you're taking on all this risk. I mean, you look at, a lot of the challenges that have transpired for investors over the course of the last few years with the market shifting, it makes it to a point where you go, I shouldn't take this risk. I mean, I'd rather just park the capital in a T-bill and, let it sit there and grow at 4.25, 3/4% and be happy with that. So do you think this is kind of the writing on the wall long term for blue states? Because I've seen a lot of investors go, I can't invest in this state anymore. I'm going to take my money elsewhere. I'm going to take my business elsewhere.
Yeah.
This trend is going to continue, or will we see some recalibration? And, when the pendulum swings too far one way, sometimes it always finds its way back to the middle. But what are your thoughts?
It always seems like there's someone out there wanting to buy a deal.
Yeah.
And so, and if they don't have the exposure to a marketplace, for instance, in Seattle, like I do, and understand the nuances of it, I mean, they make bad bets.
Yeah.
I don't know how they're making, to be honest.
Yeah.
Um, there are also, there's in this region, there's a lot of wealth. And so that wealth is always looking for a place to park itself. Money never sleeps. So they buy these deals, and a lot of this is tech money that may be, a brainchild in technology. I mean, you name it, it's all up here. Google, Apple, Microsoft, all the big tech is here.
Yeah.
And they might, do well in that industry, but then migrating to industry is complicated as fine. And they're not underwriting their deals properly or don't have the experience to know how to underwrite a deal. These deals get bought and traded, and I don't know. It's not how I do business, but I do see that quite a bit.
Yeah.
So back to your question, I really wonder what the heck's going to go on with the West Coast. It's a very tightly controlled market, and government is making the cost of development untenable. And I mean, it takes 5 years to get a permit out of, in LA, we had all these fires. And, the first thing Gavin Newsom was talking about is how they're going to streamline the permitting process.
Yeah.
Well, when it takes 5 years to get a residential permit in California, I mean, forget it. People are going to walk away from that dirt, go to Phoenix. It is not a sustainable model, and it's not one I'm going to invest in. So I don't know what the heck's going to go on, but it has to change. It's not sustainable, in my opinion.
Yeah. Yeah.
I mean, I have friends who develop deals in LA, big multifamily projects.
Yep.
I've talked to them off, candidly, and they just have a legal team on permanent retainer because every project they try to do in LA, they just got neighborhood groups soon enough just to stop the development. How do you make how do you make money doing that kind of business? So they have a law firm on permanent retainer to kind of fend off those lawsuits.
That's wild. Yeah. I
And
mean,
that's before they even get a permit.
it's crazy to think about. I mean, it makes you rethink your business model, right? It makes you rethink what's really worth it. We're all investors. We have an appetite for risk already, day one, right? I mean,
Yeah,
one of my
comes with the territory.
comes with the territory, right? I mean, one of my favorite quotes is volatility is the price you pay for trying to get rich. And so obviously we know that there's going to be peaks and valleys, but there's also calculated risk, right? And that's what investing is how much can I mitigate my downside, and is it worth, based on what's still left there, to go and take these risks to try and capture the upside. And it gets to a point, like you said, where these headwinds against investors, against developers, against people that are, I think a lot of people just think, we're rolling around with billions of dollars in our pocket, when a lot of investors outside of institutional capital or mom and pop investors who have, saved, who've taken risks, who've worked their butts off, and they put themselves in a, position to generate some wealth. And they're doing it the right way too, right? I mean, they're trying to add value to communities. They're trying to bring in businesses, bring in tax dollars, properties, that I think are, net positive. And it gets to a point, in these kind of markets where it makes you second guess things a little bit. So I'm curious, as your model sits today, how do you guys kind of classify what your company is? What do you guys do? What is your expertise? And where are you guys burning calories right now in your overall investment model?
Great question. So I got away from ground up development a long time ago. That takes a very, for a couple of reasons. One, what I could comfortably take on as a risk in a development project was small enough to, I could control the process that we were just talking about. Well, it wasn't large enough to get me any horsepower in the deal. I'm just breaking even at best. And to your earlier point, you have to evaluate the risk you're taking and the reward. And there's a risk reward continuum that I constantly bounce back and forth from one end to the other, trying to evaluate whether a deal is worth it.
Right.
Um, what I found worked well for me and my skill sets and my partners is the value add. And, I've been a housing architect forever. So for me, the natural pivot when I got into the game was to go into housing. I've always just been fascinated with it.
Yep.
I think it has the potential for me to do the greatest amount of impact on my tenants and improve life, and then improve neighborhoods if I really clean up an asset. It's complicated, a lot of moving parts. But, the only way I saw that, unless I develop, like there are a couple of towers in downtown Seattle right now, they're 40-story towers with, a pedestal base, and you got two 40-story towers coming up on either end of that pedestal. So there's like 200 units going up. I mean, it is a monstrously complicated project management exercise. I mean, trucks are rolling all day long. Bought a street from the city for a year and a half to kind of stage it. It's not, I don't have the horsepower to do that. So what we can reasonably manage is like a 250 unit apartment complex where we do a big value add. And for your listenership that doesn't understand that, I mean, the only way you create wealth in real estate is to grow your NOI. And so you can do that there's only 3 or 4 knobs you can really twist to make that happen. You can grow your income, you can cut your expenses, you can maximize efficiency, and somehow cut costs and things like, insurance. Good luck. Um, Labor costs, contest your tax bill every year, which we do. And then you've got on these value add exercises some tax advantages. So you've got bonus depreciation, a few other things. So those are the only knobs you can really twist.
Right.
Um, you can't do a buy and hold and hope to make money. It's just not going to happen, especially when values are going down, not up. So we like that value add game where we're really renovating units and getting about $100 to $150 a month bump on the rents. There you are. We're growing our gross income. And then at the same time, we're absolutely controlling the the expense side of our ledger. So we're trying to just grow the spread between expenses and income. That's how you make money. That is an orchestra that we have to conduct. And, so then you get into a business model where you're trying to absolutely conduct that operation as efficiently as you can. So, we have 200 people on the payroll. They're all on a W-2 for labor costs. We control our supply chain, direct vendors from India and China. It's shipped right to the Port of Houston. Our drivers go down there, pick it up, take it to our warehouse, and then when we need it, we just call it up. We're getting our slab countertops for $50 a slab. And I was just pricing slabs for my own house last weekend. It's $1,500.
Yeah.
So, so that's the game we play. And our value add, it's like 18,000 a unit. For anybody else, it's 35 to 40. So we're creating real value there. And that's a business model that works in any kind of market, up, down, sideways, because we're absolute, it's financial engineer.
Right.
That's what we're doing. It's financial engineer.
Talk a little bit about that from your perspective for those that are going, what do you mean by financial engineering?
It's a very complicated spreadsheet. And there's a lot of assumptions and a lot of empirical data that goes into that, and a lot of calculations we perform. Just from the initial inception of the deal to the exit. So things like debt and equity, expenses and operational overhead, and how much can we reasonably assume to raise rents annually. What's the what can we expect in terms of government reaching out trying to raise our tax basis every legal expense. I mean, all of that's baked into this pro forma. And we're trying to prognosticate an event 5 years out because all of our deals are underwritten for 5 years.
Right.
So you keep it very, very real and conservative. And I've seen too many people play games with these pro formas and they get cooked.
Yeah.
They're buying it at a 7 cap now, and they're going to exit at a 4 cap 5 years. What? That does not happen. And playing with that one knob on the back end of the deal, I've seen too many people do that, but that can have a ginormous impact on your exit value.
Oh yeah. Well, I mean, that oftentimes can be the difference between, a deal producing yield or not, a deal completely sinking versus, barely staying afloat. And I know that you're somebody that takes pride in how you guys analyze and underwrite and engineer, these models, right? We talked about it before we jumped on the show here live, which was, it's one thing to be somebody that, can put some numbers in a spreadsheet and model a pro forma and make it look all sexy and go out to your network and put some social media posts out there and raise some money, which ultimately we saw a lot of people do post, 2020 to 2022 with all the amount of money that was flying around there and just the frothiness around deals in the market. And then all of a sudden, with all of those, I call them the blue sky pro formas where, rents are never going to plateau or even go backwards. Operating expenses, they're going to stay fixed. Cap rates, they'll never expand. All of these assumptions that were very rosy when things shifted, going back to Warren Buffett's quote, if you see who's swimming, naked, when the tide goes out, we saw that we're probably still, and I'm curious to get your perspective on it, in the early stages of that distress and pain in certain asset classes and, certain um, markets. But before we talk about that, what are your disciplines that you guys know from all your years of experience, being in and out of deals, full cycle many times, that are must have staples in modeling from a perspective or maybe a specific assumption, rule of thumb that you guys like to use? Like, how do you bulletproof your modeling going into the deals?
One of the basics is, you got to do a very thorough survey of the marketplace with your rank. And too many people don't do it. It's like, they pick these numbers out of air. We're going to get these rents. Yeah, I can tell you that doesn't happen. And so, in a housing market where vacancy, so the natural equilibrium in any housing market is about a 5% vacancy. You know, and when you get less than a 5% vacancy rate, that's when you start to see rents kind of generally rise because there's greater competition, fewer units online. And in markets where you're seeing a lot of product being built, it's a classic sine wave. And so you're seeing more units come online, which is decreasing competition. Same units, the rents are going to fall a little bit as a consequence. You might even start seeing some concessions.
Yep.
Um, so we are very careful about. I mean, a couple of things I monitor carefully is building permit activity in any market I'm in.
Yep.
I also look at how many deliveries of new units are coming out in any given year. So in Houston, for instance, we had record number of units being construction in the last 23 and 24. Right now, mid-year 25 is when we're starting to see that we've worked through that pipeline. And I just read a report this morning where, we might see an actual 1% bump in rents this year down in Houston. Woo-hoo. You know, um, and Houston historically has been a 92% vacancy, occupancy market, about 7 to 8% vacancy rate down there. But we're finally coming back. It dipped down as low as 88, 89% there last year. All these deliveries come.
Okay.
So, you're starting to see it tighten up down there a little bit. And, we might cautiously dip our toe in the latter half of this year and start looking around for another deal. We've been on the sidelines oh God, we bought 2 last year in the late Q4. And those were distressed deals where developers came in from New York, bought them up. They bought 6 deals, 5 deals, and lost all of them. Everyone. And I know the 2 deals we bought, I heard anywhere from $20 to $40 million of investor equity got evaporated. And we bought them at like 2018 prices. It was great. But those are one-offs. In terms of an overall market moving in a unified direction, we're not. So, we'll keep looking, but we don't have enough confidence in the marketplace right now to want to start taking down deals. For the last 2, 3 years, you've heard a couple of taglines, stay alive till 25 and extend and pretend.
Mm-hmm.
And banks have been playing along with that because there's like, you probably know, I mean, how much real estate is bad debt on these bank balance sheets right now?
A lot.
$1 trillion or something. I don't know.
A lot.
Banks are that runway's kind of running out.
Mm-hmm.
And operators got to stop pretending and get real. And, they're either going to have to sell at a loss and the keys back.
Yeah.
Because they are not going to be able to buy any more rate caps. Banks are done. And only the strongest operator is going to survive.
Yeah. Talk about that a little bit. I think there's, people get all excited about how sexy they can make a deal look on paper in a spreadsheet, engineering a model. But I always tell people, as somebody who has, self-operated all of my own assets or most of them, and, had exits and understand what goes into that. What's in that spreadsheet and the reality of what it takes to get that brought to life is a lot of hard work, a lot of sacrifices, a lot of risk, a lot of, challenging times that you and your team have to be ready to lean into, or else, as we are seeing in many different scenarios, right? You got a lot of people just laying down and saying, man, I didn't expect that, or we didn't plan for this. Here you go. Here's the keys back, or we're foreclosing, or we're doing capital calls, or deed in lieu, or whatever it may be. So from that perspective, like, talk about, because my opinion is you can always find somebody to model a deal for you, and that's a great skill set to have. Don't get me wrong. I mean, I've really leaned into trying to master spreadsheets and engineering, and 15 years into my commercial real estate journey, I feel like I'm still learning, right? Uh, that being said, there's this skill that goes, I just feel it's one of the highest ROI skills that real estate investors should and need to develop in order to have a long, successful, and, lucrative career, which is understanding real estate operations. Now, every asset class is different.
Took the words out of my mouth.
It has its own nuances, right? Like, they're all a little bit different, but for the most part, in mechanics, and to your point, right, understanding what levers you can and can't pull.
Yep.
Talk about some of the operational disciplines that you guys have really leaned into mastering, that you feel has made you guys successful, that has allowed you to navigate challenging times. What does that look like from your perspective?
Well, first of all, I think you nailed it. Most people do not, especially the people just getting into the business,
Right.
do not understand that operations is everything between success and failure. And if you haven't got your operations together, I don't care how good it looks on paper. It doesn't matter. It does not matter, because you will fail. So, so we are hyper fixated on operations. I mean, in this downtime where we haven't been going after deals, all we've done is completely look at every nuance of our operations to try to maximize every ounce of efficiency that we think of. We have 200 people on the payroll now, and it's everything from asset management, the on-site managers, to the C-suite, to the construction guys. So it's about 60-40 management, asset management, construction. And we're constantly, that's a lot of people to kind of get on the same page, moving in the same direction.
Right.
So that is problem one right there. How do you manage this beast? And you can't. A lot of these folks have a pretty low education level. Not knocking that at all, but you've got to keep your goal articulated in a very easily digestible fashion.
Mm-hmm.
And then, the little stuff you don't think about when you're just starting out, but when you start managing a portfolio of 15 different assets, the goals for one property aren't necessarily the goals for the next. We might have like a C-suite level goals, the partners,
Right.
and we're trying to move the Titanic in a certain direction, right? Well, then how does that get dissipated down to the properties where you have on-site personnel who say, well, we're going to turn a unit this way as opposed to a different property? So, no, we do it this way. Well, and you're trying to work product for the entire portfolio, and so the consumption is different. And so we have been hyper focused on trainings. Recently, we just hired a new HR director who is very good at this sort of thing, and we're just trying to get everybody to buy in to what the program is for the business, and that when we all buy in and we're all moving in the same direction, we all win.
Yeah.
And your year-end bonus is going to reflect. So that's like one of the big ones is dealing with labor. Labor is just, no one thinks about that when you get into real estate. But my God, it's like the number one line item in any budget,
Yeah.
is like dealing with this labor. And look, at that level, I mean, somebody gets 50 cents an hour off or more, they're gone. And they won't even give you 2 weeks notice. And now you've invested like 6 months of training. When they're gone.
So
You're going to start over. So, I was having a conversation with my partner 2 weeks ago. It's like, look, you've done this enough. You should know by now that you're going to invest more money in the retraining somebody you know is going to leave in 6 months instead of offering market plus 5% on the salary. Why are we like being pinching pound foolish here? This is stupid. I mean, just like get over yourself and like figure this out. And
that's just the construction, right? Like you get what you pay for. And laboring is such a challenging, industry as it is. You
yeah,
try and, scrape the bottom of the barrel to get the cheapest.
but more to the point is you can train people. I mean, and you know, but you have to develop the trainings and then have the trainings and then
Yep.
consistently have. And nobody thinks about that when they first get into real estate. They think, well, I'll just hire a third party manager. Well, that doesn't, it does not work. Nobody's going to operate your deal as tightly as you want it operated or as well as you are.
So you guys are in-house PM, property management, and
Yeah,
for
we have,
that exact reason, right? Nobody cares about your deal as much as you do.
yeah, we operate our own deals. We haven't. I mean, we have an acquisitions leg, and then we have the operations management. And so, we learned that lesson long ago.
Mm-hmm.
And so that's the challenge. It's, I have another deal, one last deal here in Seattle. And every 2 weeks, I have a partner call, and we're talking with the on-site manager. And I can't tell you the trouble we've had just getting that thing under control. And we've had turnover. The asset manager. And first, we had a regional manager, and then we had a different regional manager. We're on our third one at 3 years. I mean, you just can't get any consistency or momentum going.
Yeah.
And that right there is what operations is all about.
Yeah.
And, if you don't have your operations under control, it's really hard to make a profit.
Yeah. I always tell people, if you're operationally sound, but your model is a little bit off, that is better than your model being locked in, but your operations are off.
Yeah.
Because that right there is you have very little delta and room for error on operations than you do
right.
on your modeling, on the engineering of your deals. So I love your perspective on that, being that you guys have done it at such scale. You guys have, obviously, I always tell every real estate investor to, theoretically, the ones that have been in the game the longest, they take their shirt off and they got all kinds of scars and butt kicking. But those are the lessons that allow you to learn. Why I love interviewing people like yourself who have, been through market cycles, who have navigated a lot of the different challenges, is I don't need to go and learn all those mistakes by myself. When I do get those expensive lessons, it's usually either when my ego shows up or I think I know more than I do. And really all of those, learnings, all that information, all of that stuff that could be helping whatever individuals trying to move their, investing goals forward, it's around you. You just got to tap into the right conversations, be in proximity to the right people. And also just using the data that's around you to remove the emotion and let the data drive the decision. And I know you're somebody that loves data, as do I. Actually have a white paper that you, I think, just finished or created recently around kind of the overall state of the multifamily real estate market and kind of an overall. And we'll kind of keep, for those that want access to this, we'll share here at the end of the episode where you guys can connect with Mark and his team and all the great content that they have. But overall, from your perspective, I even heard you say, which my ears perked up, a potential black swan event. In the cards here, like give me your overall thoughts on maybe some of the things that you were diving in and found here in, this pretty comprehensive and deep research.
Well, first of all, it's no secret that our political environment right now is challenged,
Yep.
and it's making doing business really difficult. We are taking a wait and see approach. I am decidedly apolitical in forms like this because I play with the house money, right? And so I, I, I can't afford opinions.
Right.
Can't play to one end of the spectrum or the other. All I can do is read the tea leaves and try to make the best decisions possible on behalf of my investors.
Yep.
So I've been following this, like anybody for seems like forever now. But I decided I want to take a look at what the market was telling me mid-year 2025. We've gotten past the pandemic.
Yep.
And interest rates until about whenever it was tariffs went into place were really steadily trending down to where it looked like what was going to accomplish its goal by the Q4 of this year. And so I was trying to get out in front of it and kind of look at the status of kind of where things stood in the industry. There's a lot of really pretty heartening news. I mean, a lot of the excess inventory had been sucked up. We were starting to see some stabilization in the interest rates. Bond markets seem to be cooperating. Vacancies were rising pretty steadily across the country for the last few years. And right now, I feel like where we're sitting is we're at the bottom of the trough. Again, real estate runs in cycles, and it looks like a sine wave. So we're at the bottom of a cycle coming up the backside.
Yep.
And that's where this report was written. Since then, there have been some headwinds that, there you go. It's classic order.
There we go. The four quadrants.
Yep.
So you're saying we're kind of at the bottom of this multifamily recession, troughing out a little bit, starting to head back into this recovery.
And back up, correct.
Okay.
I don't know if now we're going to stagnate along and just bump along the bottom. What is concerning to me is I get up every morning. The first thing I look at is the 5 and 10 year.
Yep.
And the 5 year, which is what I like, given the duration of our deals, I always look at the 5 year.
Yeah, and if you don't mind sharing a little bit about that for those that don't understand why we like to track the 5 year, the 10 year, like from your perspective, what does it tell you? What do you look for? Why is it important to track?
Because it's ultimately dictates what interest rates are going to be for loans on your deals. So usually it's going to be SOFR plus a spread, something like that. And so the 5 year is the bond market, and so interest rates are tied to the bond market. And so we're frequent flyers, but who knows what the spread's going to be. So generally it's going to be like a point three quarters, maybe 0.65 up to maybe 2.5 points on top of a base rate. And so, I just kind of do the math real quick, and you're seeing multifamily deals, that the interest rate for a lot of these loans is like 6.5%. And that's not a place where deals get done.
Yeah.
6.5 is not where deals get done. So that bond rate has to come down to, at least 25 basis points. And the 5 year is stubbornly clinging to just a hair over 4%. And it's been there for months. And we need it more like 3.75, 3.65. So that's where deals get. Whether we're ever going to see that again, I don't know. Because, we'll just go back 3 years, 4 years. The Fed kind of pumped the economy full of money during the pandemic. M1 is the money supply. And, it put the economy on a sugar buzz. That's why inflation occurred. It's not political, it's Econ 101.
Right.
And so ever since then, pandemic, they resolved that. But then you had the aftermath. And that was squeezing all of this money out of uh, the economy. The only way you can do that is buy it back. And so the Fed was buying back all these bonds, and actually they've done a damn good job of like constantly buying it back to where I don't know if they're buying them. I don't know if they are or not. But Fed's not the only buyer of our product. Those things are get up every day. You can track what the auction is for bonds, and that's what scares me. Is if we don't have buyers for our bonds, this country literally goes back. And right now, markets are spooked by these tariffs and especially by this big, beautiful bill that is going to just run up our national debt.
Yep.
And our national debt is not sustainable. And, I don't like funding billionaire classes at the expense of the working folks. I'm from a working class background myself. But, you know, um, if Japan decides to stop buying bonds, they're the number one holder of our bonds. The game is over. And so I am carefully watching this. If this bill passes, I'm afraid we're going to go. I don't have any empirical evidence for this, but I'm just wondering if we're going to cascade into another black swan.
Mm.
And for your listenership, I mean, probably sophisticated enough to know what that looks like. It's like 2008 and 9. All right, just a major economic event. And I won't say it's calamity or anything like that, but it's an event. And we cannot keep piling these events on top of one another. They seem to be coming with greater frequency than they used to.
Right.
We went through 80 years of stability post-war, and that entire system is collapsing right now. And then, we have all this national debt. There's just a lot of headwinds out there that
Right.
makes it really hard to read the tea.
Man, I mean, you you said it. Jamie Dimon recently has been saying, "Hey, all eyes on the bond market." There's some cracks in the bond market, right? I mean, you've been seeing what's been going on internationally with Japan's markets, and that kind of being a little bit, in my opinion, foreshadowing and really affirming, some of the issues that many people are starting to point at, right? With the big, kind of public spat between Musk and Trump last week. It was all over Musk criticism. And obviously, I'm sure there's lots of other things that we can talk about as being, but big criticisms on the spending bill. And how, that continues to enslave future generations and this unsustainable path that we're on. I mean, these are real things that, we can just keep it's not going to impact me, kick the can down the road. I'm not going to do anything about this. It's not going to show up at my doorstep until it does.
Right.
How should investors, let's just say in the real estate world, be thinking about this, protecting themselves? Is there anything they can even do? And should they just keep investing in sound, fundamentally, strong deals? Like, how do you navigate this time when the noise gets really loud? The easy thing to be would be, I'm not going to do anything. Or do you find a way to navigate these challenging times, understanding historically, looking in the rearview mirror, there's always a way to kind of navigate and find your way through it, but it's challenging and it's scary. So what are your thoughts?
Several. One, you can't stuff your money under the mattress. You can lose money if you do that.
Yeah.
And any sort of big event like this, there's always up. And so, the reason why I continue to love real estate is it's a fixed asset.
Yeah.
And if you underwrite the deal correctly, and if you create value where there was none before, which is why I like the value add game.
Yeah.
Because I am creating value on behalf of my investors. Am I going to say it's all roses? No, but it's better than watching your portfolio stock market tank 40%. I have this deal here in town, and we've had it 7 years now, and it hasn't panned out the way we had hoped. Pandemic, city of Seattle, zaniness. But my investor is still going to make a little bit of money.
Yep.
And they haven't gone back. And that's a win, given the times and what we've just been through. So for me, it's a flight to security, real estate.
Yep.
A lot of people like gold. I tend to not like commodities because of the volatility. Gold can go up, gold can go down. A lot of people are all over these meme coins now. I don't know the first thing about them. And so asking me about it is it's a kind of a useless exercise. I'm told there's value there somehow. I fail to see. To me, it's all Dutch tulips. I don't get it. I really don't. It's all contingent on whoever gets to the top of the mountain first, and then their coin gets institutionalized and becomes the commodity of choice, right? That's, to me, what I see going on. And you got all these coins coming online, and so now you've got greater product. To me, it looks a lot like the .com speculation. But I'm hardly the guy to talk to about this. So I stick with what I know, which is real estate. I like bricks and dirt. They're not making that much anymore. So so for me, it is a good balance to any portfolio. Done correctly, you can actually get a pretty decent return.
Yeah.
You can get distributions plus profit on the back end. You make about 20% annual.
Do you guys pass any of the cost seg or tax savings on to your investors?
Oh yeah, yeah. You get the tax advantages too, and those are huge.
Yeah.
And those carry forward. I have so many tax losses, and I'm never paying taxes again.
It's a beautiful thing, right?
Yeah, that's worth something, right?
Absolutely. Yeah. There's the cash flow game, there's the tax flow game. You pair those two together strategically, and commercial real estate looks pretty damn sexy. And like
what's interesting about the tax flow game is that's not calculated. It's part of
never. This is kind of a random thing, but I've been trying to think about with my spreadsheet, whiz engineer guy on my team, like how can I find a way to factor in the tax savings and like quantify that within, how do you tie that into a yield or an IRR or an equity?
Problem with that, first of all, if you can bottle that, you'll make a fortune. But I've thought about that problem for years.
I can't wrap my head around it.
Well, tax thing out of Washington is so volatile that what's true one year is not going to be true the next.
Right.
So you can't quantify.
Yep.
Yeah. So you just do a tax, a cost seg, and you get $1 for we do it pro rata.
Yep.
And so you get
based on the equity stack.
Correct. Yeah.
Okay.
So sometimes you get these huge write-offs. These losses, these just paper losses, and it's not like it's a real loss. It's depreciation.
Yep.
And for your listenership that don't understand it, it's the bonus depreciation that Trump put it in the 2017 bill, and it expired in I think 2022. And from what I'm reading, that's
20% per year.
Yeah,
it's
all accelerated in year one.
It's back on the table now to get reinstated up to 100%, which, as real estate investors, we love that. That's one part of the big spending bill I like. But yeah, to your point, right? There's so many benefits that come along with real estate investing, but you got to do it right. This isn't just because it sounds sexy and it looks sexy that you're going to come in and I think, that whole get rich in real estate, has over time been slowly debunked, and people are always say, you got to have a crock pot versus a microwave mindset when you're coming into real estate. But you got to be investing with, if you're not the expert, then it's right, the Marks of the world. It's, great operators with great track records, with good reputations that are doing it the right way and going, hey, you're not gonna hit a home run on every deal. But if you model these properly, you have the staying power to weather the storm through the peaks and the valleys of an economic cycle or a real estate cycle. And, you do the right things, you can come out on the other side and still, hey, we're hoping for a triple, we got a single. Well, guess what? Singles, you hit enough of those put, runs up on the board as well.
Doubles.
Yeah, all day long.
What last couple of points I want to leave people with is like this business, you are drinking from a fire hose every single day. It really is a grind. And you've got to be able to pivot very quickly. And that's where like my experience comes in really handy because I've dealt with these things 1,000 times. So I kind of know how to deal with it. It's not fun. And it's always a headache.
Yep.
I got an issue on a project where, I thought this wall, demising wall between suites was permitted under the shelf package. And come to find out it's not permitted in the shelf package. I got to do it on my TI package. Come on, and why is that important? Well, I can't build the wall until I get my TI permit. I want to build the wall right now.
Yeah.
And I have a $400 a day fine from the developer every day I go past a certain date that I don't have that wall. And it's like, well, shit, I could just build it this weekend. Case closed. Well, I can't do it. So I've got to call into the building official. I got to talk to him this afternoon. It's like, beg.
Yes.
That's the kind of stuff.
Yeah.
That is the day-to-day of real estate investing. And so if you don't like dealing with this stuff, you can be an LP on deals, a passive investor, and you make a pretty good with an experienced developer, experienced operator. You make a pretty nice rate of return. Generally, our deals are 8 prefs. That's the distribution every year, and a 20 IRR over the life of the deal. But you're not getting that in the stock.
Yep.
You are not getting that. So, so I think where I have finally gotten with this is like, just don't get greedy. Just, strap on for the ride, the day to day, and be happy with doubles. And like, keep your ego tucked in your back pocket. And just be very data driven and very grounded in the business. It is a business. Perfect. And, you can make a lot of money, and I think that's where a lot of the cowboy attitude comes from. But I choose to be very grounded and very pragmatic. I'm from Midwest, and believe it or not, I'm an introvert, and so I just, I don't want to be bothered for the most part. But I have a very determined, made a decision a long time ago that I just want to be honest with people, and give them good news, bad news, whatever.
Yeah.
But I don't want to gloss over kind of the realities of the business.
Yep.
And I think too many people do.
Oh,
they don't have the experience to understand, which is
right. Yeah. Well, I know a lot of people are going to want to know more about your deals. I know you take passive investors. I know that you guys are always looking for, the right opportunities. So if more people want to follow what you guys are up to or connect with you, your company, where's the best place for them to do that, Mark?
Yeah, you can reach out to me at investor at SGRE investments, that's plural.com. You can also use my architecture address, mark at SchulerArchitecture.com. Schuler is spelled SHULER. I'm in front of this box all day long, and I love talking about the business. So happy to kind of pull off and have it.
We will be sure to link up all that contact information that you guys can find on the episode. Mark, it was a pleasure chatting with you. Thanks for coming on.
My pleasure. Thanks.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionofmindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Million of Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.